Now we can look at paragraph 27. Now, paragraph 27 works as follows. It says, where proceeds do not exceed expenditure. So, subject to subparagraph 2, where the proceeds from the disposal of a pre-valuation asset do not exceed the expenditure incurred in paragraph 20, incurred both before and after the valuation date, then you must use this paragraph. Now, this basically just means, guys, we're going to start off by doing the exact same thing. Right, you'll see this method I'm giving you guys here always work. Cost before, costs after, 1 October 01, and we have a total. Okay, so let's look at our example. Now, this is a company with December year-end, purchased a factory for 2 million in May 2001, born to use on that date, sold it in 2040 for 500,000 rands, agent's commission of 10%, other advertising costs of 20,000 rands, market value of 550 on the 1st of October, and time portion of base cost of 680. Right. Basically the same type of situation, but obviously a little bit of different amounts. Right, so we start with cost, 2 million rands. So this is the cost when you purchased it. Less allowances, 5%, 14 years. Same story. You can see the solution there also, guys. And basically all I want you to see is, I want you to see the treatment. How do we do this? Tax value, 600,000 up to that point. Then we say, other costs, there's agent's commission, 10% times the selling price. How much was it sold for? 500,000 rands, so 50,000. And other advertising costs were incurred, 20,000. Right, so that total over there, 70,000. $670,000, 670,000. Okay, then that was step 1. So A, B, C. Okay, our next step is now to calculate a recoupment. Again, guys, just the principle here. The tax value is the actual tax value, 600,000. Selling price, limited to original cost. Now in this case, the original cost, the selling price is 500, original cost is 2 million. So we can see it is less than our original cost. Alright, now 500 minus 600 creates 100,000 rands. Now this 100,000 rands is, you cannot have this is called a scrapping loss for buildings. All I want you to understand now, again, this is a whole study section. All I want you to understand now is that the recoupment in this case equals 0. Right, so there's no recoupment. So, our proceeds is selling price minus recoupment, 500,000. Now we can choose our valuation date value. Right. Proceeds is how much? 500,000. Total cost, part or amount C, is how much? 670,000. So, which one is the bigger? Total cost is bigger than or greater than proceeds. So what I want you to understand, it means we are now looking at paragraph 27. Okay, so guys, I want you to now see and make sure that you see. The very first thing that you do when you look at paragraph 27 is you go to paragraph 4. Paragraph 4 says, Where the provisions of subparagraph 3 do not apply, the valuation date value of that asset is the time apportionment base cost. Okay, now, so they say where subparagraph 3 does not apply. Now, I'm going to just tell you what subparagraph 3 says. Subparagraph 3 says where a person has determined the market value. So, in other words, subparagraph 4 means where a person does not have the market value. If you don't have the market value, you will always just use time apportionment base cost. Right, that's what it says. Not too common to see. Alright, but in all other instances where you do have the market value, we will do the following. Do we have the market value? I just want you guys to see. The market value is given to us. Alright, now make sure that you see how this works. It says, where a person has determined the market value of the asset, and the expenditure allowable in terms of paragraph 20 before the valuation date of that asset. So they are telling you here to look at column A. They're saying the expenditure before valuation date. That's 600,000. So they say take that 600,000 rands. Right, so I'm going to just put it down here. 600,000 rands. They say it must be equal to or exceed the proceeds. The proceeds we saw already was 500,000. And it must exceed the market value on the valuation date, which was 550. Okay, so what I want you to see is what you do is you now say the cost before 1 October 2001 did it equal or exceed the proceeds, and did it exceed the market value? So you ask this question, did this cost equal or exceed the proceeds? Yes. And did it exceed the market value? Yes. So 2 yeses. If you say no for both situations, or no, or yes and no, or no and yes, this section will not apply. So basically what I want you to see is they say, if this applies, so if 600,000 rands is greater than the 500,000 and greater than the 550, which it is, in both instances we've said yes, then you must use the higher of market value or proceeds less expenditure of the valuation date value. Okay, so all I want you to see is what we're going to do now is we say the following. All right. So thus use paragraph 27. So the first thing we say is market value was determined. And now what I want you to see, we put down this rule here and just apply it. So we say the costs before 1 October 01, so part A, was how much, guys? 600,000. Now we say that exceeded, the first one they ask us, did it equal or exceed proceeds? In this case, it exceeded proceeds. So you can see I'm answering, applying that as I'm going. Plus it exceeded market value. The market value that they gave us was 550. Now, make sure you see. So if you say, if you ask that question we just did, and you say, yes, it exceeded proceeds, and yes, it exceeded market value, then you must use the higher of market value or proceeds less cost after 1 October. So thus use higher of market value, which is 550. Right? Use the higher market value of 550. Or use what? Proceeds less costs after 1 October 01. And I want you to see, guys, it's not times 20%. So proceeds is how much? 500,000 rands. Minus column B, and column B was 70,000. Right, so 430,000. So thus, valuation date value equals the higher of the two, 550,000. So our base cost is valuation date value. I'm just using a bit of shortcut there, guys. 550 plus other costs. These are the costs after 1 October. So column B again. 70. Okay, it gives us a base cost of 620. Our capital gain is proceeds 500, base cost 620, so we have a capital loss of 120. Now the only thing I just want to point out to you, and you'll see it in those extra questions, you must ask, did the cost before 1 October equal and exceed the proceeds? So yes, and did it exceed market value? If you say no to both or no to one of them, then you must not use the higher of the following. Then they tell you, you must use, if the provisions of item A do not apply, this is item A. So if that does not apply, you must use the lower of market value or time apportionment base cost. And you'll see that in your additional lecture examples when you are working through it. Follow the same approach I did, guys. It will take you a while to work through them. There's a lot. Right, and then you are gold for base cost. But like I've said to you again, should you go into all of this detail of valuation date value, that is questionable. I would suggest you just say as the greater of these three, even in this paragraph 27 situation we were just in, and move on. I cannot imagine that it will be too much at this point in time.